Copper just ripped to a record, and the tape looked manic. On January 29th, copper on the London Metal Exchange spiked to about $14,527 a ton before backing off. Reuters called it the biggest one-day jump in more than 15 years. Tin also ran to record territory in mid-January. And now the pushback is getting louder. The same analyst crowd that is structurally bullish is also saying, slow down. This is education, not financial advice. Here is the promise. By the end of this video, you will know what drove the January surge, what is real versus reflex, and the 3 clean signals that tell you whether base metals are still tight or just loud. Let's anchor the timeline first. The blow-off move hit late January. Then on February 3rd, Reuters ran a reality check titled "Bullish, Not Breathless." The message was simple. Copper, tin, and aluminum can lead this year. But the January fireworks were not a sustainable pace. Now I want one anchor example we can keep coming back to. Picture a mid-sized company building power gear for data centers. Think transformers, switch gear, and the thick copper bus bars inside them. They quote projects months ahead. Their risk is not price charts. Their risk is margin, lead times, and whether they can deliver on a fixed bid. So, what happened in market terms? Copper went vertical, tin went supernova, and aluminum joined the party. Part of it was a softer dollar. Part of it was a wave of speculative buying, especially out of China, according to Reuters. And part of it was the long-running energy transition story. More grids, more electrification, more metal. But that is not enough. A real risk and recap story needs a mechanism chain. Here is the chain in plain English. Step 1. When the dollar falls, commodities priced in dollars feel cheaper abroad. That can pull in buyers on the margin. Reuters flagged the weaker dollar as a driver of the late January copper spike. Step 2. When momentum kicks in, futures and options flows can do the rest. If funds and retail speculators chase the breakout, the price can outrun physical reality for a window. Reuters said the rally was fueled by speculative buying. Step 3. The price move itself becomes the catalyst. Producers and merchants start adjusting offers. End users pause, hoping for a pullback. Liquidity thins, and each buy order moves the screen more. Plain English translation. This can turn into a financial copper squeeze, even if real copper demand is only steady. Now, why is the Reuters February 3rd piece important? Because it gives you the market split in one frame. Analysts are still constructive on copper, tin, and aluminum for 2026. Reuters summarized forecast year-over-year gains around 20% for copper, 16% for tin, and 12% for aluminum. But they also warned the January surge looked unsustainable. That is a key pattern. Bullish on the year, skeptical on the path. Here is your first receipt moment. Put the chart on screen. LME 3-month copper printed roughly $14,527.50 on January 29, then settled near $13,612.50 that day per Reuters. That intraday wick is the risk candle. It tells you buyers were aggressive, but also that supply showed up at the top. For our data center supplier, this is where the real world starts. When copper spikes that hard, suppliers quote shorter. They shorten validity windows. They add metal surcharges. If you bid a project in December, your January procurement budget is now wrong. Now, let's test the most common misread. A lot of people hear record copper and assume there must be a physical shortage right now. Sometimes that is true, but not always. In a futures-led spike, price can run first and physical tightness shows up later, or not at all. So, we need receipts from the physical side. One clean place to look is exchange inventory. A public proxy is LME warehouse stocks. Macro-Micro, which pulls from LME data, shows LME copper warehouse stock around 174,675 tons on February 2. That number by itself is not the whole story. But it is a check on, are we running out today? Another physical proxy is China. Reuters noted that the Shanghai copper contract also hit a record on January 29th, up about 6.7% to 110,170 yuan a ton. That matters because China is a pricing engine, even when demand is mixed. And this is where the story gets interesting. Reuters explicitly said physical demand in China looks sluggish even as prices ripped. That is a mismatch. The screen says panic. The factory floor says not yet. Plain English translation. The market is trading the future, not the warehouse. Now, zoom out. Why are copper, tin, and aluminum singled out? Because they sit in the intersection of electrification, electronics, and lightweighting. Reuters framed copper as the key conductor metal, tin as critical for solder and electronics, and aluminum as a lightweight workhorse. The demand story is real. The question is timing and whether supply responds. Tin is the extreme case. Reuters described tin blowing through old peaks, with the rally narrative focused on supply shortfall, and prices jumping past $51,000, and then beyond $54,000 per ton in mid-January. Tin is a smaller market. When flows hit it, it can gap. That is why tin is a useful stress barometer for financial demand versus industrial demand. So, here is the stakes ladder in human terms. In the next 24 to 72 hours, the risk is whipsaw. If positioning is crowded, a dollar bounce or risk-off day can knock copper down hard. That can shake out weak hands, even if the long-term story stays intact. Over the next 2 to 6 weeks, the risk shifts to demand destruction. If manufacturers see prices stay high, they delay orders, substitute where possible, or run down inventories. That is exactly the bullish, not breathless warning. High prices can cap the very demand story that bulls are counting on. If this persists into spring, the pressure point becomes real economy pass-through. Cable, wiring, appliances, autos, and construction inputs start repricing. Then you see it in inflation prints and in central bank tone. Now, one more link to rates and equities. When commodity inflation fears flare, bond markets can price higher for longer, and equity multiples can compress at the same time. We even saw miners catch a bid in UK equities on February 3rd as gold and copper rebounded, while tech sold off. Back to our data center supplier. If copper stays elevated for weeks, they have 3 choices. They eat margin, they reprice contracts, or they delay builds. That is how a metal chart becomes an earnings story. In the next block, I want to separate 3 drivers: dollar, flows, and physical tightness. Then we will build the 3 signals you can track every week. The easiest way to understand this move is to split it into 3 engines: the dollar engine, the flow engine, and the physical engine. Start with the dollar. Copper is priced in dollars on the big screens. So, when the dollar softens, copper often looks cheaper to non-US buyers. That can pull forward buying and squeeze shorts. Reuters pointed to a weaker dollar in the January 29th surge. That matters because it can exaggerate the first leg of a rally. Now the flow engine. In a breakout, the market does not need a new factory. It needs new orders on the screen. If funds chase momentum, price can gap. Tin is the poster child. It is a smaller market, and Reuters described prices pushing past the low 50,000s per ton in mid-January. When that happens, even small flows can look like a stampede. Plain English. Sometimes the market is trading positioning, not production. Now, the physical engine. This is where the story either graduates into a real squeeze or fades into a spike. You do not need perfect data. You need 3 clean checks. Check 1 is visible inventory. The LME publishes daily stocks and daily changes. Macro-Micro shows LME copper warehouse stock around 174,675 tons on February 2. If that line keeps sliding while price stays high, tightness is getting real. If stocks stabilize or rebuild while price stays high, you have more of a flow story. For our data center supplier, this is consequence number 2. Their procurement team will start watching inventory reports like a weather map. If stocks keep falling, they lock supply early and accept surcharges. If stocks stop falling, they negotiate and wait. That decision changes hiring and delivery dates. Check 2 is China pricing versus London pricing. China sets a huge share of marginal demand. When Shanghai runs to a record like the 110,970 yuan print Reuters cited on January 29th, the question is why? Is it real end demand? Is it restocking? Or is it financial demand chasing the move? One way to infer that is the gap between markets. When Shanghai is screaming higher, but physical demand is sluggish, like Reuters noted, it is often a sign of speculative heat. If the gap narrows and stays narrow, it is more consistent with real demand. If the gap widens and then snaps back, you often get a fast reversal. Check 3 is the metal that breaks first. Tin is a stress test for electronics. Aluminum is a stress test for packaging and transport. If copper is the headline, you still want to watch whether tin and aluminum confirm. Reuters summed up a bullish 2026 view, with analysts looking for copper, tin, and aluminum gains on the year, but they also warned against breathless extrapolation. Confirmation matters because it tells you whether this is broad inflation pressure or a single market blow-off. Here is a second receipt moment you can show on screen. The Reuters February 30 framing is the receipt. Bullish on the year, not breathless on the path. You can flash the forecast ranges and then show the January wick in copper. That contrast is the story. Now let's talk anomaly, because this is where virality lives. The most viral version of this story is not copper hit a record. It is prices screamed while physical demand looks soft. That mismatch is a market plumbing problem. Price is supposed to ration demand. If demand is already soft, why is price still running? There are a few clean explanations that do not require conspiracy. One is that inventories are sitting in the wrong place. Metal can exist, but not where the buyers need it. Another is that financing and hedging demand is spiking. Another is that the dollar move is pushing every commodity screen higher at once. Plain English. Sometimes the market is paying up for flexibility, not for metal. Now connect it to the rest of the tape. If base metals are ripping on a weaker dollar, you often see the mirror image. A softer dollar can lift commodities, and that can feed inflation expectations. If inflation expectations lift, yields can rise, or cuts can get priced out. That is when the copper chart starts to show up in rate markets. If rate volatility rises, equities can wobble. You can see it in leadership shifts. On February 3rd, Reuters reported London's FTSE tilted toward miners as metals rebounded, while other parts of the market lagged. That is a small example, but it is the linkage. For our data center supplier, consequence number 3 is financing. If rates stay higher because commodity inflation is sticky, their project financing costs rise. Now, metal costs and borrowing costs are moving together. That is a double squeeze on new builds. That is how a commodity move can slow capex. Now, the second common misread. People assume energy transition demand is a straight line. So they hear record copper and think demand is exploding right now. But demand can be real and still be lumpy. Projects get delayed, budgets reset, policy support swings, and high prices can push buyers to pause. The fix is simple. Do not debate the narrative. Watch the receipts. If inventories keep trending down, if China pricing stays firm without snapbacks, and if multiple base metals confirm, then the demand story is translating into tightness. If those receipts fail, the narrative may still be true long-term, but the path can be ugly. Now, lock in the 3 signals. Signal 1 is LME copper stocks and the day-to-day trend. Where to look is the LME daily stock report, or a clean tracker like Macro-Micro. What matters is direction, down versus flat. Typical lag is days to a couple of weeks before it hits physical premiums. Signal 2 is Shanghai versus London pricing and whether the gap widens or closes. Where to look is SHFE copper and LME copper on the same day. What matters is whether Shanghai strength holds when demand headlines are soft. Typical lag is fast, often within a week. Signal 3 is the confirmation basket. Watch tin and aluminum alongside copper. Where to look is their front-month prices and whether they hold gains after a spike. What matters is whether the group stays bid together. Typical lag is 1 to 3 weeks for the broader macro read-through. In the next block, we are going to map the catalyst window. What could flip this story in the next week, and what would make it stick into the next month? Now we need the catalyst window, because that is what turns a chart into a news story. Base metals do not move in a vacuum. They move around data prints, policy vibes, and risk appetite shifts. The next 24 to 72 hours risk is dollar and macro surprise. If U.S. data comes in hotter than expected, the dollar can bounce. If the dollar bounces, commodities can cool, even if nothing changes in warehouses. That is why the dollar engine matters. It is the quickest lever. The next 7 days' risk is positioning and liquidity. After a record wick like copper printed on January 29th, the market is sensitive. Any profit-taking headline can turn into a cascade because everyone is leaning the same way. This is especially true in smaller markets like tin, where Reuters warned the run-up could look like a bubble to industry. When a market is thin, price does not need bad news. It just needs no new buyers. Plain English. A spike can end when the buying stops, not when the story changes. Now, look out 2 to 6 weeks. This is where the physical engine either confirms or fails. Do premiums rise? Do inventories keep dropping? Do end users complain about availability, not just price? If you start seeing that, the metal move becomes sticky. If you do not, the market usually reverts, then grinds higher later. So, what do we watch exactly without turning this into a spreadsheet? We already set the 3 signals, but now we assign the timing and the so what. Signal 1, LME stocks. If copper stays elevated and LME stocks trend lower, the market is telling you tightness is real. If copper stays elevated and LME stocks rebuild, then the rally is more flow-driven. The lag is short. You can often see it within 1 to 2 weeks. Signal 2, Shanghai versus London. If Shanghai stays strong and the gap does not snap back, that is consistent with steady Chinese demand or restocking. If Shanghai leads and then collapses relative to London, that is consistent with a speculative pulse fading. The lag is fast. This can flip in days. Signal 3, confirmation across tin and aluminum. If copper is strong but tin is rolling over, that can signal the electronic side is not keeping up. If aluminum is weak, that can signal broader industrial demand is not accelerating. If all 3 are strong together, that is when macro markets start caring because it looks like broad input cost pressure. Now we bring back our anchor example again. The data center supplier is the real economy receiver of this move. In the next 72 hours, they will mostly see chaos in quotes. Suppliers tighten terms. They stop holding prices for weeks. That forces the company to delay bids. Over the next 2 to 6 weeks, they will see the harder decision. Do we lock metal now or gamble on a pullback? If inventories are falling, they lock. If inventories stabilize, they wait. That single choice changes project timelines. If this persists into spring, it shows up in customer behavior. Hyperscalers and utilities start spacing projects. Not because they hate data centers, but because the input bundle is now more expensive and less predictable. That is how a base metal story becomes a capex pacing story, and then an earnings call story. Now we need to be precise about risk framing. We are not saying metals will crash. We are saying the January pace was extreme, and even bullish analysts do not expect straight-line gains. That is what Reuters meant by bullish, not breathless. And the copper wick is the visual proof. Here is the pressure point, the what breaks first line. The first thing to break is not demand. It is hedging behavior. When end users cannot tolerate the volatility, they step away from the market, or they hedge aggressively, which can amplify swings. If you see sudden drops in liquidity and bigger intraday ranges, that is the pressure point showing itself. Emotion control, newsroom safe. This is not doom. It is a signal story. The January record candle tells you the market is stressed. The next few inventory and cross-market checks tell you whether it is a real squeeze or a positioning blow-off. Now recap the mechanism one more time. Clean and simple. Dollar softness can lift metals. Flows can exaggerate the move. Physical tightness is what makes it stick. The mismatch between record prices and soft demand headlines is your anomaly and your viral hook. And now I want to end where we started. Record copper is not the story. The story is whether this is a true tightening cycle in industrial inputs or a financial burst that fades. Here are your 3 markers again. Watch LME copper stocks and the trend. Watch Shanghai versus London pricing and whether the gap holds. Watch tin and aluminum for confirmation. If those 3 stay aligned, base metals are not done. If they diverge, expect chop, not a straight line. That's the risk, and that's the recap. If you want the clean signal check, look at those 3 markers this week. I'll see you in the next one.